This is David. David is looking to invest in real estate, but has come across a term that he is unfamiliar with: preferred return. David seeks out help from his friend Jim, who has been investing in multifamily real estate for many years. Jim tells David that is awesome news because a preferred return adds extra protection for investors. Jim gives David an example of preferred return from his first multifamily investment. Jim says the preferred return of his first deal was 7% with a 30% split to sponsors after the preferred return was paid. In that deal, Jim had invested $100,000. That meant that each year, Jim got 7% return, or $7,000 first, before the sponsors took a single dollar for their split. After Jim was paid 7%, the remaining net gains were split with the sponsors, where investors took 70% and sponsors took 30%. Jim tells David that a preferred return builds accountability from the sponsor team and allows management to show its investors that the property is expected to not only reach the preferred return, but exceed it. A preferred return is powerful because it is accrued, meaning that if the economy is down and the property is only able to pay out 5% to investors that year, the remaining 2% are still owed to the investors, and they must be paid before the sponsors can get paid. David is excited because he now understands the importance of a preferred return on investment deals and why it's a powerful tool to help protect investors.